Let us consider how consumer spending drives stock market movement. Discover that the more consumers spend, the more companies make increase turnover, and the more it will affect the bottom line. And that increase in profit will lead to increase in earning per share. And increase in earning per share will result in an upward movement, upward trajectory, you know, for stock prices. So consumer spending is a key driver of economic growth, and it plays a significant role in influencing stock market movements. And as consumers know, as consumer spending accounts for a large portion of economic activity, and so changes in spending, whenever there's changes in spending patterns, actually will often have a direct impact, on corporate profits. And not only that, investor sentiments, as well as you know, uh, as well as an overall impact on the stock price. So earnings influence investor confidence and influence investor sentiments, and investor sentiment, will equally have an impact on the stock price, on stock prices. So here is how consumer spending influences the stock market. Number one is impact on corporate revenue and profits. Impact on corporate revenue and profits. So in an environment of higher consumer spending, so increased spending typically leads to a higher demand for goods and services. So these demands will certainly boost corporate revenue and profitability. So companies in sectors such as retail, consumer goods, and services, tends to benefit from strong consumer spending, often resulting in a rise in stock price, in stock prices. So let's look at a lower consumer spending. A decline in spending, signals a kind of a weaker demand, which can hurt corporate earnings. And so sector sensitive to consumer demand, such as retail and luxury goods, often experience stock price decline in response to declining consumer spending. So consumers actually, determines to a higher degree what happens in the market. Number two is economic growth and investor sentiments. Economic growth and investor sentiments. So whenever there's economic expansion, strong consumer spending is a sign of economic health and growth, which can lead to increased investor confidence. And so as consumer spending drives economic activity, it supports a positive outlook, for corporate earnings, encouraging investors to buy stocks and then to stimulate market rallies. So how about economic contraction? In the case where there's the economy is undergoing a contraction, a slowdown in consumer spending can signal potential economic stagnation or recession or an economic downturn. So reduced consumer confidence can lead to increased market uncertainty and lower stock prices, especially in consumer dependent sectors. So number three is influence on specific sectors. How does consumer spending influence specific sectors or industries and in the markets? So when it comes to discretionary spending, you will then realize that consumer spending on non-essential goods, example in luxury items, electronics, and entertainment, is a key indicator for discretionary sectors. When consumers are confident, they tend to spend more on items, boosting stock prices of companies in retail, in technology, and in travel industries. Whenever there's the economy does well, it's what they call, consumers will travel to exotic destinations, and that involves spending. So In and when we want to consider staple spending, we've looked into discretionary spending. We want to consider staple spendings now. So in the case of staple spendings, these are like spending on essential goods, like food, like health care and utilities. These are staple spending. Whereas discretionary spending has to do with luxury items, electronics, and travels. In the case of staple spendings, it's a more stable and less sensitive to economic cycles. Actually, it's not all that influenced by the economy. It's less correlated with the nature of the economy. So stocks of companies in consumer staples tend to be more resilient during economic downturn because demands for these products remain relatively steady. Regardless of how the economy performs, people are bound to go for utilities, medical treatment, and food items. Please subscribe to this channel and give this video a thumbs up. Like this video, it will do me a ton of good. Number 4 is consumer confidence and market behavior. Consumer confidence and market behavior. We want to consider positive consumer confidence. Positive consumer confidence. You discover that high level of consumer confidence generally correlates with higher spending, which boosts market optimism. And so as consumers feel more secure about their financial future, they are more likely to spend more, leading to a higher corporate turnover and eventually a higher corporate earning and growth in stock prices. In the case where you have a negative consumer confidence, then what happens? So low confidence actually, low confidence often leads to, leads to reduced spending, lower level of spending, which can signal economic trouble or recession. So investors concerned, about slowing consumer activities can trigger market pullback or corrections, particularly in a consumer sensitive sector. Number 5 is inflation and real purchasing power. Inflation and real purchasing power. Let's look at inflation impacts. If inflation is rising, the real purchasing power of consumers will certainly decline, as you all know. So higher prices for goods and services can lead to reduced spending, especially on discretionary items. This can dampen corporate growth and hurt stock prices. However, if inflation is moderated and there's an increase in wages, the spending may remain strong, supporting stock market performance. If the government comes in and then try to see how they could mitigate the impact of inflation, then of course it would impact stock prices positively. Then equally have concerns about wage growth. So when wages increase, we discover that consumers tend to have more disposable income, supporting higher spending and driving economic growth. Whenever there's an increase in wages, in salaries, people have the buying power to be able to consume the more, and that will lead to a heightened level of stock prices. This can lead to reduction in consumers. This can lead to people spending more, and it will equally affect the market positively, and stock prices will climb. Number 6 is interest rates and consumer spending. Interest rates and consumer spending. In a rising interest rate environment where there's rising interest rate, higher interest rate increases the cost of borrowing and making consumer goods and mortgages more expensive. This can lead to a reduction in consumer spending, particularly in big ticket items like cars and homes. So if there's a rise in interest rate, that means that there will be an increase in borrowing costs. People will curtail their borrowing activities, and as a result, we may not be able to buy items like cars or homes at a rate that is expected. So lower spending may negatively impact stock prices, especially in sectors sensitive to interest rates. You have falling interest rate. In a falling interest rate environment, what do you expect? So lower rates reduces borrowing cost and stimulate consumer spending, which can boost corporate profits and positively affect, and stock prices. Whenever there's a drop in an interest on borrowing, people will tend to borrow the more. The more they borrow, the more they spend, and that will have a positive impact, in the overall market movement. So, in conclusion, consumer spending is a critical component in driving stock market movement, with its effects felt across sectors and industries. So, strong consumer spending supports economic growth, corporate earnings, and rising stock prices, while weak spending, signals economic challenges or economic downturn or decline or recession, which may lead to, a market downturn.